All right, so we are recording. We're live. We got Cicero here. How's it going, buddy?
It's going good. How are you?
Good. This is our first one-on-one that we've had. Beautiful. All right, I haven't coached you off screen. I haven't told you what to say or what to wear. All right, so you can see my Webull on the screen, and we got Zach on the screen. I'm unable to load my camera in for some reason because I think it's the screen share OBS situation. But I'm going to keep trying to work on that for future classes. So one of the first things that I want to do with you, sir, is get a portfolio management strategy in place. Because I think that's where you're going to have a little bit of a better starting point. I know you're eager to jump into the speculation. I love it, but we just got to make sure we tread safely.
We'll make sure we're being smart.
Yeah. So it doesn't mean we can't do it, but if you're going to do it, there's nothing against using a paper account, right? We can kill it. So kind of what I know, like I rambled a lot on the webinar, which is good. But you're gonna have to rewatch that a couple times. But we kind of briefly covered the portfolio breakup, right?
Yeah.
Did you have any specific questions about that at this time? Think of this as like
No,
a
I
therapy
actually
session.
really liked it.
Okay.
And I kind of want to go with, I think, exactly how you have it laid out.
With a 70%, 30% split.
Yeah. I
Okay.
really like that idea.
Okay. So do I. um, all right. So something like this then, modified, obviously. So you put 70% into. Let's rewind here. I'm going too fast again. I'm sorry. I had a monster. Um, so consistent contributions, right? That's what fuels any savings account. It's what's we just kind of. It doesn't have to be huge. You don't have to make any contributions at all. But the goal is to basically put payments in and then make that money work for more. So they can come from, putting some money from a paycheck in. They can come from just reinvesting your dividends, whatever it is, right? Money makes
Yeah.
money. So obviously, when you're starting out, you don't want those to be, 80% of your paycheck because then you're gonna be uncomfortable and probably broke because you're going to lose a lot of it. So let's slow that down. So you got your contributions, and you're saying that you want to take 70% of what you put in and set it for passive income, growth, dividends, things like that, and then the remaining 30% you want to dedicate to allocation and/or settled cash. They can collect that
Yeah.
broker interest. Okay. Um, and then I think at that point, it's just a matter of figuring out kind of what you want to do on each side of the fence, right? Okay. Do you know about how many positions you'd like to have for that 70%?
So your other one that you showed at the first session, um, I don't know if you have it on here.
This guy?
Yeah, that one.
All right. Got a lot of
Pretty
spreadsheet.
much, pretty much that.
Okay, perfect. So,
I,
so
I like the idea. Now, if there's stocks that pay better dividends but are a little more expensive, I might go
combine
for
them.
that. But
Okay.
yeah,
All right, and those should be stable, right? So it's
yeah,
kind of okay to under diversify that a little bit, as long as it's stable. You don't want to do that in the low flow garbage or the high risk stuff. All right, so you got up to 7 dividend stocks. Are those all going to be dividends? Do you think that based on what you know so far? Because this may change, and it's always going to be okay to change stuff.
from what I know, I think I want to do dividends. That way, more money reinvests.
Okay.
Money makes money.
Money makes money. That's it. And in theory, as long as we pick the right stocks, and by pick the right stocks, I don't mean guess. We pick strong, financially stable companies that want to reward shareholders, and they're making money. These should outperform the 5% that your broker would normally give you on that same settled cash. Okay.
Yeah,
Otherwise, if you find that you're not making that, you can always just shove it back into settled cash, right?
makes sense. Yeah,
Easy peasy. It's not a lot of money per year, but it's better than losing money, right? So
it's better than no money.
there you go. And then for the 30%, you kind of want to dedicate that to speculation. Do you have a preferred trading style? Now, this specific thing, this no longer applies, so I'm going to erase this because the settled cash rule it's now overnight, so you don't have to worry about that. But
Yeah, I'm not sure what I want to do yet. I like options, but those might be a little too risky.
I love hearing you say that.
So
Good stuff.
I've had experiences.
Fair enough, man. All right, so
So
so you got
I think it,
30%. Sorry, go ahead.
yeah, I think I still got to learn this different styles of specs.
Okay, perfect. And that's a good place to start, right? Rather than just I want to do this. That's kind of what I set you up for. I was setting you up to fail, but you passed. Because a lot of people do. They just want I want to master spy trades, and then they're not here a year later. So
I mean, it'd be nice, but
yeah, it would be awesome.
it's not really a good starting spot.
No. All right, so we've got some we got 2 branches on this tree, right? So far.
Yeah.
So let's move into the next one, right? So you're kind of comfortable dedicating all 7 or all 70%, I should say, no matter how you break that up, into dividend stuff, ideally. And then you've got some amount, 30% of your portfolio or 30% of what you want to use for speculation. Do you know roughly how many trades per day you'd like to take, or how many you can take?
I'm not sure.
Not
I
sure.
think that one really depends on the trade.
Okay, perfect.
Yeah, just no more than 30%.
Beautiful. All right, so that kind of tells me that you're leaning more towards the 1% rule.
Yeah.
Okay, so like no speculation trade should ever ruin more than 1% of your portfolio, right?
Yeah.
Seems like a pretty easy rule to follow. It's not. It's a simple rule.
It's
All
hard to
right.
follow.
So what we can do is we can say, X trades per day, and then instead of this, we can change this to N dollar. Oh, let me just put that in front so it's grammatically correct. Per trade, right? And then we could say 1% rule, right? So we're going to modify this a little bit, and then what we're going to do is change these raw values into percentages in our minds, right? I'm going to leave this here because I don't want to go too far with the changing blocks while we're on stream here. Okay, so you've got what size portfolio are you working with roughly?
Currently I have $998 because I did a bad trade today.
Okay, so around 1,000 then.
Yeah.
All right, so
The idea is to start with 1,000.
okay, so one of the things that I'd like to do, and let me just share that as well. I'm just going to open this up. We're going to actually build the plan out for you. Are you familiar enough with this flowchart? You kind of got a good idea of it in your mind?
Yep, I did a screenshot.
Okay, perfect. All right, cool. So let me open this up here. Can you see my notepad here?
Yep.
Okay, I'm typing a million words a minute. I'm awesome. All right, so you've
I
got.
don't know if that was even one word.
So you basically have a $1,000 portfolio, roughly, right? Because we want to treat this as brackets, right? And we're going to take action once certain brackets get hit. Think of this like a big trade, right? Your portfolio is the ticker. It's the price range, all right? So we got to set a take profit and a stop loss on that as well. So you want to put 70% or $700 into dividends, roughly, and then 30% or $300 for speculation, okay? And you've got some number of trades, N dollars per trade, and you want to use the 1% rule, do you think, or do you want to use a different
I'm
rule?
not too sure yet.
Okay. Well, I think.
Go ahead.
Sorry, I was thinking it might be a really good place for you to start because it forces you to slow down.
That's probably the smartest way to do it.
Okay. Only because you can't take 10 trades per day on that size account with the 1% rule, or really any account, because it kind of forces you to use bigger allocations with tighter risk ranges. So you can't, like, you might use $180 in one trade to still get the same end result as 5 trades on like $20 or $30 per trade. So it kind of forces you to slow down and focus on quality, and mostly to minimize that risk, right?
It's probably the smartest way to do it.
I try to be smart once in a while. So you've got some amount per trade based on the 1% rule. I think it's also worth having a max daily profit and loss so that you know when to stop trading. Do you have a preferred number in mind for that? Do you feel like if you make a number and it gets too big too fast, you kind of identify what that cutoff might be for yourself? Like, do you ever have a big trade in the past?
I don't even know where to start.
Okay, no worries. So how about we do, let's say 3% up for the day, or 3%, or I'm sorry, 6%. Okay, we'll do 3 and 3, right? 3% up for the day, 3% down. 3% down for the day. Oops. All right, so these are when we stop trading, right? And again, I can't legally tell you what to do, but that's the idea, right? So what we're doing here is we're establishing the parameters of your strategy, and we're just building in limits. We're saying, okay, when this gets hit, I stop. When this gets hit, I stop, right? Now what we can do is we can establish a range, because since you're doing this part specifically on $300, 3% of $300 is pretty small.
Yeah.
So it's not going to help you. I'm sorry, it will help you. It's not going to cause you to be like ecstatic or despairing and all that good stuff if something goes right or wrong. So this ultimately results in you having up to 3 losses for the day, and up to maybe 2 profits for the day if they're uninterrupted, but you have 3 trades if you take a loss. It's just how the numbers work out. Does that sound about right?
Yeah.
Okay. And of
I think
course,
so.
if you hit, if you have 2 wins for the day, you're done trading. Even though you have the 3rd, you're done for speculation, right? It's boring. It sucks. I get it. It's not super profitable, but this is a great starting place so that you can at least identify what you're able to do and not do. That's kind of why we're doing this.
It's a good start.
Yeah.
Yeah.
All right, and then for the week, right? We also want to set up a weekly loss and target profit range, right? So stop trading daily, stop trading weekly. Oops. Okay. So what do you think might be a good number here for your? It's a little bit of a math problem here, right?
Yeah, that pretty much. I'm not good at math.
Okay, no worries.
It'd pretty much be.
Right?
Yeah.
You think 10% might be? I mean, if you can get up 10% on 30% of your account, which is 3% for the week, right?
Yeah, that sounds good.
Sounds good. All right. And we'll do maybe 5% down for the week, right?
Yeah.
Maybe. We can change the numbers
That
later.
adds up to 1 for 2. 1.
Yeah. Yeah, pretty much. So if you take 30% of your portfolio and you lose 5% of that in a week, it's maybe time to slow down. Right? It might not seem like a lot, but that's 5 losing trades for a week.
Yeah.
Without any wins, so it might just be a bad week. Right? It doesn't make it, not necessarily anything against you. Maybe it's just not a good time to be trading. Okay. So again, and that really just forces you to kind of follow a system. It's not anything about your profits. I don't really care about what your P&L is right off the bat. I want to see how well you can follow this plan, and it's a plan you're making. I'm just giving you pieces, and then you pick those pieces, right? All right, so for the day, for the week, you know when to stop trading, for better or for worse, right? And I would really rather you paper trade these when you start, for at least a week or two, just to see kind of how you can handle it. And we'll have follow-up calls, obviously, on Mondays, just to make sure that this is something you can follow. For strategy, do you have a particular preferred strategy? I know a lot of people like the 20 MA strategy.
I was going to say, I would like to learn more about the 20 MA. I think that's
Okay.
the one we started on, and I think it's the one we should stick to starting on.
Okay. All right.
Does that make sense?
Absolutely. No, it's consistency. I love it. So you want to try the 20 MA strategy, and we can kind of dig into that today too. We have a little bit of time. And this will probably be the quickest trading plan build I think I've ever done with anybody. So that's pretty good. So
Leave it to me.
Yeah. So there's a couple pieces left. The next one is going to be your note taking, which we'll get into in a minute. And then let's see, what else should we include here? Yes, brackets, right? We want brackets on our portfolio. And the reason we want to do this is because we're humans and we suck at adapting to change. Granted, that is one of our huge superpowers as a species, but that took millions of years. Within our lifetime, and specifically within a couple of weeks or months, we're really, really bad at it. So when we're starting with $1,000, we don't want that to go to $3,000 in the same week, because we're going to freak out and we're going to lose it. Right?
That's fair. Yeah.
And when we talk specifically about the 1% rule, what we want to do is find one number, and in this case it's $30, right? So no trade while you're using $300 allocation should ever exceed a $30 loss, right? So we can keep that number all the way down to $800, right? So if we lose $30 at a time, we get down to $800. We know we then need to reduce that number because our speculation amount is $100. $100. Sorry, the denture is messing me up today. Does that sound about right? Or it doesn't have to be 800, it can be 900.
Yeah.
Okay.
I mean, it makes sense if you don't want to lose all your speculation, because then you got nothing.
Yeah, and it can scale down infinitely too, right? So the Archimedes arrow thing. So I think for you, for now, let's keep it at 900. Just because you want to kind of head that off. If you're losing that much money that quickly, you want to head it off and change those positions down so they're smaller. So 900 on the low end. And then we can just add that same amount to the upside.
So 1,100. Yeah.
Right? And then this is basically just it's a take action bracket. So when the portfolio value cumulatively drops to $900, we want to adjust our allocations that we're using for the 1% rule.
Okay.
Got it?
Yeah.
Because that means that
Because then at that point, $200 would be in the speculation.
Yep, and that would be a $20 risk instead of a $30 risk.
Yeah.
Okay. You're not going to make as much on the upside, but it scales nicely. That's good. And then $1,100 on the upside would leave $400 in your speculation, which is a $40 risk. So $80 profit, $40 loss, right? And then, of course, once you're up in the $1,100 range, then you bump it up, right? You just follow that $100 range up, or $200 range up and down as you hit each number. It's not going to be overnight, so you don't have to worry about doing this every day. And that's it. And this number should always be available to you if you track your notes, if you track your positions, right?
Yeah.
Okay, so let's dig into the note-taking part right now, because that's probably the most important one, right? So you're going to want a trading checklist for each trade, okay? You're going to want the ability to document your dividends. We can build you a spreadsheet or a tracker. I have one for the PB stuff, so it's easy enough to use that. And then you're also going to want notes, right? Just notes for yourself. Environmental factors, stresses, right? And you don't have to share all that with me. This is just for you. You could just say, hey, I've got some stress, for this area of my life.
You don't want to be my therapist?
No, I don't think I'm licensed, man. Can't tell you what to do with your money. I can't tell you to treat your emotions. I just tell you to write stuff down. That's what my job is. All right, so these are kind of this is the golden triangle, right? You want a checklist to make sure that you're able to have a consistent list in front of you, and that's going to measure your execution. Okay, that's just how well you can do things over and over and over again. We'll build that today with the 20 MA strategy. Then you've got your dividend position tracker, spreadsheet, whatever you want to call it. That's basically to track your investments over time. So that's just a way to keep track of your stuff, mostly for your reinvestment stuff, right? And then notes for yourself, that's basically just so you can kind of get that self-awareness built up and kind of identify things about yourself, about your trading, and their impact on your money, right? Because money itself brings its own stress, right? So that's good stuff. And I love that you have a job where you're outdoors, you're in nature, so that kind of automatically helps. You get a lot of sunlight, get a lot of vitamin D. I mean, you probably...
trade out on the hammock.
Yeah, there you go. So you've already got a huge advantage over people that don't go outside, right? Because they don't get that same, set of emotions, right? So
yeah,
it's good stuff. So part of this is also going to be what I want to do here on the $1,100 bracket. I want to add in some actions. We don't have to decide anything today. Basically, what we got to do is decide when your portfolio gets up here to $1,100. Do you want to reinvest and trim back down to 1,000, or do you want to let it grow? Do you want to take a portion of it? So at some point, when you're a little more comfortable and experienced with this, we're going to want to identify something to do with that. So that way you know what to do. So your portfolio doesn't grow outside of a familiar range and start messing with your head, because that's going to happen. All right, does this seem like a pretty good starting point for you?
I like it so far.
Okay, and what I'm going to do is I'm going to put this in our Discord as well, and I'm going to pin it, so we always have it. All right, so let's do that right now. It's pinned. You guys can't see it on the recording, and you can't see it on the screen share, but it's there.
I see it.
All right. Good stuff. So now I guess the only piece that we really have left is the strategy, right? The actual technical analysis and the execution part, right? Does all this make sense so far? Is it
yes.
Reasonably safe, I think?
So far, I think it's very safe.
Okay.
And we can change it down the road. But
absolutely.
Right now, I think safe is probably the best.
Okay. And we're going to dig into the dividend and investment portion. We'll do that a little bit later on once you kind of learn more about the stock market.
Yeah.
And then for right now, we'll just worry about the speculation, because I think right now you're probably better off just with that settled cash. But now your broker, if it requires a subscription, you might not get a net profit on that. So pretty soon we're going to want to build out those dividend positions. Now you said that you're comfortable buying more stable stuff like VOO, the Vanguard ETF, Schwab, SEHD, things like that. You can absolutely go
Yeah.
ahead and do those now if you want. I won't stop you.
Okay.
Because I personally just like those two, and they cover the entire market sector-wise.
Yeah. VOO is one that I had on public before I decided to get off public.
Fair enough. Fair enough. Some it's just really hard to go wrong with, and I like those two. So,
Yeah.
all right, and then yeah, we'll flesh out the rest of your dividend positions. It's really hard to not succeed with these because they're just slow as hell. But if you take a loss on it, it's okay. If you have to sell the shares and buy a different dividend stock, because it's better. Because most of the time you're going to be selling for a profit anyway. So that's it.
Makes sense.
Yep. So within those 7 stocks, also what we can do is we can choose to. Have you already taken some losses this year?
Well.
Okay, the laugh. Yeah, the laugh. Familiar with that one.
Oh yeah.
All right, so you're already got a head start as far as tax loss harvesting at the end of the year. So if you wanted to, a lot of us traded like Tesla, Clip, some of the higher risk, high yield ETFs. Those are primarily for tax purposes. Because at the end of the year, what we want to do is we want to hold on to the dividend positions that we like, and we want to sell the garbage to kind of offset our profits for the year. And we want those kind of placeholder positions like Tesla and Clip to pay us aggressive dividends so we can also recoup some of our money. Does that make sense?
I think so.
Okay. Do you have any questions about it? I don't want to go too far ahead.
I'm still not exactly sure how all that works.
Okay.
Or the like tax stuff.
Okay, no, well, let's talk about that.
I don't know if that's important at the second though.
Yeah, kind of. Well, I'll give you a brief overview, and then we'll dig into it later on when we actually start looking at stocks.
Okay.
Okay. So basically, when you buy a dividend stock, right? You know what a share is, right? It's a piece of a company that they've offered to sell. Yeah. Okay. So some shares have a dividend attached when the share is listed, and basically, when you buy a dividend stock, it comes come dividend or with dividend, and then when the ex-div date hits, that's without dividend, that piece of that share is taken off. It's converted to a cash payment for you, and then you receive it at a later date, and the share price gets adjusted because that piece is removed from it, so the price gets lowered automatically. And then, of course, that ex-div date typically has some sell-off or some volatility. Sometimes they go up, sometimes they go down. It's like a mini earnings. But the price is adjusted either way, right? And then when it comes time to, consider that process at tax time, what you're doing is you're receiving a capital gain, which is just money that you've made that the IRS wants a piece of. That's the dividend payment. So you're paying yourself, basically. And then if you sell those shares for a loss, that's a capital loss. You get to claim those as a deduction at the end of the year against those profits that you've made. It's just a little bit of plus minus at the end of the year, and then you're allowed to claim up to a certain amount based on your own circumstances. And you kind of just get that money back at the end of the year, and anything you don't use gets forwarded to the next year's until it's all gone. Right, so we don't want to lose money, but it's not all gone forever.
Yeah, you kind of get it back.
Yep.
It essentially would get taken off your capital gains.
Yeah, that also counts towards your earned income as well. So if you have a job and you get a salary, it counts against that as well. Or I'm sorry,
Cool.
it all factors in. So, but that's a conversation you want to have with a tax person that's licensed and all that good stuff, not some guy on YouTube. All right.
Some random guy on the internet.
Yeah. So I know what works for me, but not you. All right. So, so basically when you collect a dividend payment, that's all you're doing. You're just paying yourself. And when you get that cash payment settled in your account, that's when it kicks in, and that's when you're responsible for a tax payment on it. Now, if you hold it for more than a certain period of time, depending on the type of stock, it might be a qualified dividend, which is it's got a lower tax rate. So those are kind of ideal when it comes to those high yield ETFs, is trying to get the qualified dividend payout, or any dividend stock, I guess, really. Because what happens is instead of paying like the 35% roughly that most people pay on income tax, you're only paying 15% for those. But you still get to claim the loss on those on the shares at 100%, which is cool. But you also don't have to sell the shares that you actually like VOO, Schwab, because you got these little shield stocks that you can just sell off as needed to kind of balance things out. Does that make sense?
I think so.
All right. Yeah, they're just little armor plates, basically. They're meant to be destructed. They're meant to protect you and protect your shares. They're not super profitable, but they do have some advantages. So you don't want to load up entirely on those because you'll lose money. But you'll have great taxes.
Taxes will be great.
Yeah, for a couple of years. Exactly. So that's kind of leads into, like, when we get to the dividend positions and stuff, we're gonna talk about the specific roles of each slot, and you're gonna want to offset, like if you do the high risk, high yield stuff, you want to offset those against the more stable stuff, because again, you want to kind of pair everything up and make sure it all makes sense. So you're essentially building your own little baseball team here. Like, you need a catcher, you need a pitcher, you need outfielders, you need basemen, you need a coach, that's you. You need to make sure the ump isn't blind, so just stuff like that. So let's put that on the side for now, and you can kind of make your own decisions ahead of time if you want to. We can always revisit the dividend stuff and kind of dig into each one. But let's dig into the MA strategy, because this is something I think you can kind of start today if you wanted to.
Yeah.
Probably in extended hours. I wouldn't recommend that, but I can't tell you what to do.
Tomorrow.
Right. Yeah. So let's build yourself a. Whoops. What's happening here? I forgot how to use Notepad. Sorry. Okay. So I meant to copy that. Sorry. All right. So your 20 MA strategy is going to be kind of your bread and butter when it comes to looking at charts, right? All this stuff up here, you don't need to look at charts. You don't need to do anything other than just pick allocations and look at research, fundamental stuff. Do some math, basically, and then this will pay you automatically if you do it right. This you kind of have to think about a little bit, but 90% of this thinking is about why you think things and how to not think them, if that makes sense.
Got it.
Yep. So your job for this small piece that you're only using 30% of your money for is to become a little robot. And it's very hard to do. So today is like your turning point where you go from a human into a cyborg. So, all right. So when you have a chart up, right, and you're considering this strategy, you should also have a checklist up, in my opinion. Right. So this is something you can write down. We're going to build a step-by-step thing for you, so you can write it down and have it on your monitor. You can get it tattooed on your leg, whatever you want to do. Doesn't matter. It's not going to make $1 million, but it will put you in front of healthy, low-risk opportunities, and all you have to do is capture the profits when they're there.
I'll put it right here in my arm so I can use a pen.
There you go. Just as long as it's not a utility pen. We're good. All right. So first thing you want to do is quality, right? You don't just want to plug low-float trash into this. Just make sure that what you're looking at is has some potential, right? It's got to have some motion on the chart. It can't just be like a massive sell-off and then a flat chart. That's not good for anybody. So what we'd like to do is look for fuel, right? Quality fuel. And this could be like Lee's Watchlist in the morning. It can be well-known stocks. You can do this on the Magnificent Seven stocks. You could do the higher cost, stable stocks if you want. Let's see here. The watch list is relatively high volatility, which is good for potential, but it's also good for hurting yourself. So maybe you don't want to use that. Maybe you want to use the slower swings on stable stuff, which is where we have like the rest of retire stocks. I don't know if you have that or not. That's okay if you don't. Okay, no worries. I'm going to teach you how to build a screener, a very simple screener that's going to help you find these opportunities, and then all you have to do is wait. Right? So let's start with those three for now. And what I want you to do is sets of 10, right? Ideally on paper, right? Paper trades. Doesn't have to be on actual paper, but in a paper trading account or something. And the advantage for that is that you get to collect data across sets of 10 trades, start to finish, right? And your job for all 10 of those trades is going to be to go down this checklist one at a time. And if you can't check everything off, that's okay. Make sure you make a note of it. So what we can do is we can turn this into a spreadsheet or some other tool or maybe an app you can use on your phone and just kind of check. Okay, I did it, right? Yeah. So step one, feeding it quality fuel. Step two is going to be identifying healthy timeframes. Right.
Sorry, so what do you mean by the sets of 10? Is that like...
I want you to do 10 trades.
10 trades. Okay.
Yeah. Now, again, ideally on paper.
Paper trades.
Yep.
Yeah.
And the goal is just trade number one. Oh, I didn't use the right position size. Or, oh, I didn't get my order filled and I chased it. Or, oh, I didn't respect my stop loss. I moved my stop loss. So the goal here, or maybe it was a low float biotech stock and you just wanted to trade it because you saw somebody else was trading it, right?
Yeah.
This
Is
is
that gonna be per day or
no, they don't have to be
just
10.
whatever?
Nope, just for your next 10 trades. Just document them.
Okay.
Yep. And you can do all these on the daily time frame. Let me show you something actually. Let me kick this back over here. And we'll go over to meow. Okay, can you see that?
Yep.
Okay. Paper trading. You see this number right here? It's
Yeah.
kind of hard to see, but that's positive, right? I started at 10,000 on this one, and it's positive. Okay. If I was on a $1,000 account, this would be $8. Not a huge chunk, but I'm also not using the 1% rule here, right?
How do you change it on paper trading? Because for some reason mine always starts out with 100,000 and then I go crazy on it.
That's because brokers want to encourage bad behavior, and that's why they do that. Yep, they want to trick people. So on here, if you're using TradingView, you can click this, and then you can just click Reset Account, and you can put the number in there.
Okay, cool.
Yep, I'm not gonna because it'll reset my account, but
Yeah, don't do that.
So if we just look at these top to bottom, you can see the criteria I'm about to walk you through is present in every single one of these on the daily time frame and only the daily time frame. Okay.
Okay.
So it's literally just random tickers. It's part screener results. I think I grabbed some from the dude had some that he was watching.
Yeah.
It doesn't matter. You flip a quarter. I don't care, right? But just make sure that the criteria is the same for all 10 of your trades. And you're going to change the strategy long after I'm gone. You're going to trade it out. You're going to do better and better strategies, more efficient ones. Like this isn't the end all be all of strategies, but it is enough to get you.
It's a good starter.
Yeah, it'll keep you in the market. It'll help you survive. It'll help you find what you need to find, basically. All right. So this trade right here, and just to show you what I'm looking for really quick, I just 3 things, right? 3 key things, and I'll go through them all in a little more detail here in a second. I look for a positive slope on the 20-period moving average. And for this one, I have a little indicator that I wrote. Here's the source for it. It's literally just making sure that the plot value
Can you
is.
send that to me?
Yeah, absolutely. just make sure that the plot value is greater than the one before it. There you go. That's it.
Sweet.
Colored moving average. So that's criteria number 1, right? And then number 2 is I look for a small red candle or a small red opportunity near that moving average. So after this turns green, after its positive slope, I look for a small red candle like this. Ideally, it's touching the moving average. It doesn't have to be. If it's something like this, I'll still take that trade. But that brings me to criteria number 3, which isn't present up here, and that's a color change. I need to see that the opening of that candle or the top of the body has been broken to the upside. Does that make sense?
Yeah.
Right? So all I'm doing is trying to catch the reversal of bearish pressure to bullish pressure with a super tiny risk when the trend is going in my direction. That's all I care about. People make this.
When the candle's shorter, it means, especially when it's red, it means there's more of a buy happening.
Well, so the size of the candle, that range from the open to the low, that just tells me what my risk range is. It doesn't really matter at the end of the day. I just want a super tiny risk. That's all I ever care about. Okay. Now there is some meaning, yes, in the terms of supply and demand and distribution and all the technical stuff, absolutely. But for getting started, we don't care. We just want super tiny risks over and over and over again because our goal for the first year is to have all our risks be the same size or less. Sound good? Because at that point, year 2, there shouldn't be any reason why you're net negative. You should be positive.
Yeah.
Right? So easy. So that's it. Those are my kind of 3 steps, and I'll walk through them all a little bit more in detail. But positive slope, red candle, and then a break over the open. Easy enough. Just shapes and colors. Okay.
Makes sense to me.
All right. So we're going to look at all these tickers really quick, and we're going to just identify that they're all still there or were there at one point, right? So this one, tiny red candle, it stopped out. This one stopped out, and then I re-entered on the break of this guy. That makes sense?
Yeah.
Criteria hasn't changed, right? This was green at the time, but it turned red, obviously, when that sold off. Right here. Okay, tiny red candle, positive slope, green entry, bam, bam, boom.
You would have, on that last one, you would have been able to take profit because it would have hit your target, right?
It did, but it didn't fill. So if you see, see the high price right here, it's 21.12, which is my target, but it didn't get filled. So that'll happen a lot, and that's okay. This one here, right? This one, I traded that one on a smaller time frame here, but that's okay. But the okay. So I'm using this big red candle right here, this range right here for this trade, because I got a positive slope and the price broke over this guy. So it's the last red candle. So it's a bigger risk, but it's still only 1.83%.
Okay.
So I don't care, right? If I'm using the 1% rule, it's going to be the same exact dollar amount. So why worry?
Yeah.
This one right here. Okay, small red candle, positive slope. We get a color change. Traded it. It kept going. Beautiful. I'm out of it because I didn't want to set up 75%, 25% brackets on this. So I just sold everything at the target. But that helps me for demonstration purposes, right? So right here, positive slope on the moving average, small red candle. This one's a little far away, but it's okay. And then we got a color change right here on this guy. And that one went up, hit target. See enough. Same thing here. We got a positive slope. Now these candles are a little bit below the moving average, but the open of the red was above it. So I was like, that's close enough, right? It's a small enough risk range. I don't really care. Less than 1% risk. Went up, hit target. This one here, no entry on this one. I'm watching it for tomorrow. So I got my line here. I got a positive slope. So I'm just waiting for that third criteria, which is going to be when the price breaks up here. Make sense?
Breaks over that one.
Yep. So tomorrow morning, what I'm going to do is I'm going to set a
Preferably green.
Yep. I'll set a buy stop order right here. So when price goes above that, it buys my shares, and I'll set a bracket right here with a stop loss and a take profit with those sell orders already in place. Then I don't have to look at it, right? I'm also going to set an alarm in case the price breaks down below here, because that means that then I'll have a lower low. So I'll have to adjust the number of shares as well as the take profit. Otherwise, I don't care. Right?
Okay.
This one here.
And then do you usually do the day time frame, or like do you recommend the day time frame?
So for these, I would rather use the daily time frame, because that's when you're just going to get the most stable price data.
That makes sense.
Yep. In time, I'll teach you how to walk down through the lower time frames and get the more stable or the more efficient opportunities, I should say. But this is just to capture that overall trend. You're just finding a low risk entry opportunity, and you're just riding the trend up for a little piece. That make sense?
That makes sense.
You're just a bear just grabbing little fish out of the river as they jump in your mouth. You're not jumping in the river trying to chase them. You're not, trying to jump off a dam, trying to catch the one at the bottom. It's not worth it. We're just standing.
This is training my patience.
That's right. You're gonna hate this so much.
I've been on the 1 minute.
Oh yeah. You're gonna like this. I think you're gonna start seeing better results. So this right here, right? Same thing. Positive slope, tiny red candle. It's a little bit away, but it's okay, right? When this was forming, this is what I saw. So it looks like the price was pushing up. That's all I need. I can justify that, right? In this case, it just happened to break down the next day. I stopped out at a 0.97% loss. Easy, right? Same thing here. We took a reasonable risk that I could justify. We got a color break over here, positive slope on the moving average at the time. It happened to break down and stop out. I don't control that. I don't care. Same thing here. We got a super tiny red candle. This was a positive slope. We got a color change. We had a nice tight risk right here at the low of this wick, because that was before this formed. And it just happened to stop out. Right? But somehow, we're still net positive. Even though we took 3 losses. It's crazy, right? Because most traders, when they take 3 losses, they wipe out their account.
They're gone.
That's it. So we're basically just bringing things back down to a reasonable set of steps that we can justify, and helping us justify it will help us be able to follow it more consistently. That's really what we're after. All right, so let's actually flesh out this strategy, okay? So we're gonna okay. So it doesn't have to be next week. It doesn't have to be a month from now. Whenever you do 10 trades, I want to see the results. Okay?
Got it.
And this is basically a therapy session at this point, because I've taught you how to trade. I won't teach you anything new after this point, as far as analysis and stuff goes, for a very long time. That's it. That's all you need. It's just some math, some shapes, and colors. Now, 90% of this is psychology, right? So that's what we're going to spend most of the time working on. All right, so let's work on the strategy here. So you're going to feed in quality fuel. This can come from a multitude of sources. We have a lot of free sources. We have a lot of paid sources for people that really want to optimize stuff. I'm not the sales guy. I just want you to be able to survive, right? So before we'll dig into the screener stuff later on, but for right now, you can use Lee's watch list just to practice. Actually, no, let's not do that. I'll give you some tickers, I guess. Or just pick 10 random tickers. I don't care. It's got to have that criteria, right?
Yeah.
If it doesn't, there's just no trade. So yeah, you go find your own tickers. Try it out. Just see what other people are trading. It'll be fun. And you can see which ones. and specifically how many don't fit this, because they're usually downtrending, right? And those are the people that end
Yeah.
up struggling, and they don't know why. All right. So we're going to identify the healthy time frame. In this time, at this point, we're just going to use daily. Only the daily time frame right now. Identify lower time frame when we're ready. All right, and I'll walk you through how to do that. And then once we have our time frame, we need to identify the slope. Right? Positive slope on 20 period moving average. Okay? Not a super complicated indicator. We're just using the moving average. That's it. And you're already, like BevNet this morning, took 4 trades over the past couple days. He won 1 of them, lost 3 of them, and still outperformed 90% of the market with a 25% win rate. And it's just because he followed his rules.
Yeah.
I think he took a 1 to 2 risk reward or something too. It wasn't even that crazy. Like, it's just the same stuff. So we're going to want a positive slope. Then we want a tiny risk. Small red candle. Moving average. All right. That's it. The smaller the risk, the better the trade. Okay. And then we need to, like, once we've identified that, we need to identify the open of the red candle, because that's our threshold. Okay.
Yeah.
And then we need to wait for a color change. Okay. And that's going to tell us, once we get the color change, the lower of any of the involving candles in that color change, whether it's a red candle followed by 2 small green candles, whether it's 3 red candles in a row and then a green one after that, the lowest of the red candles is going to be your entry threshold. If it's above the moving average. And the low of red to green, right, is going to be your stop loss. Does that make sense?
Okay. Yeah.
Lowest low of participating candles. Okay. And then oops, sorry, go ahead.
For the color change, does the color change need to be like, or does I guess you're looking at the most recent red candle. So like for this one that you're looking at right now,
Mhm.
if we look at the very recent, you have your small red candle.
Yep.
But if that was the first one that we see, like right now we see that bigger red candle. That's
Okay.
the very last one.
Yep.
The next one obviously could be changing up and down from green to red.
Yeah, so let's look at NOMD here, for example. This is the one that I'm actively watching for an entry potentially tomorrow.
Yeah.
So this is what I see today. So if I see another smaller red candle like right here tomorrow, that then becomes the threshold.
Okay. And even though that moves, that will move around throughout the day.
Yep. Yep. So you're going to get some stop outs here and there. And that's okay, right? Because we're using super small risks. And ultimately, all that's going to do, I think it was, let me just see which one it was that I did that on.
And I remember
this guy right here, I think, is a good example, right? So let me just replay here so you can see kind of what I was seeing as it played out. So we're just going to walk through this. So at the end of this day, right, this is what I saw. Okay, so I would put a line right here to identify this. And, you know, we're a little bit far away from the moving average, but it's okay, right? I'll just delete that line. We'll just ignore that one, right? Because we don't know the future, okay? This is what we'll see at the end of the day. So I said if the price goes up here, that the following day, I want to enter. Because it's a small enough risk, I can justify it. And this right here is where I'll put my stop loss. Right?
Okay.
And then what happened the next day?
The bottom of the wick.
It went up and then it went down, and that's okay. Right? Because it didn't, I don't think it went all the way up here and then went all the way down here. I think it, if I remember correctly, it just kind of fluttered a little bit, but it doesn't matter at the end of the day.
Yeah.
It's a loss. It's okay. It's super tiny.
It hit your stop loss before it hit the high.
Yep. But what that did is it actually gave me an opportunity a couple days later, because now I had a red, right? I didn't have a positive slope at that point because the sell-off was too hard. But, you know, we just got the color change on the moving average as well as the candles today. So I took an entry on that, on this paper account, obviously. And that's it. Now my actual fill is a little bit higher, but that's okay, right? So you can always watch the ones that fail Because a lot of times it might just pull back a little bit harder and then just keep going if there's a lot of noise in the chart. Like this one, the candles are kind of all over the place, so it's a little bit tougher.
Yeah.
And if you notice that happening a lot, you can always kick up the time frame even higher, right? So the weekly is actively working against me here, which is probably why there's noise. But you can also take this kind of trade. It'll be slow as hell, but you could do it, right?
And then you just hold on to that for
However
a
long.
while.
Yeah. Yep. We'll talk about take profits here in a second, but yeah, it would be just a long trade. And what you can do once you start incorporating multiple time frames is you could identify like this green area here. You could look at it on the weekly and say, okay, it turned green right here on this candle. Values. Okay, there we go. I covered it up. So yeah, this candle right here is the first one with a positive slope. So what we could do is we could go back to the daily and say, okay, now we look for, opportunities here on the daily time frame within this overall uptrend. And we've got a beautiful one right here. But maybe that wasn't green at the time, right? Maybe we take this one. Maybe we take this one. Maybe we take this one and lose. Maybe we take, that didn't happen. Maybe we take this one and lose, right? See how small these risks are? All we need is one profit.
Makes sense.
Yeah.
One profit and win, and then
that's it. That's all you need. So when we pair time frames, yes, your probability goes up pretty significantly, but we're not really worried about that right now because we just want to focus on getting the process down. Right?
Yeah.
So paper account, no real risk. We're just developing a skill set at this point. So let me go ahead and pull this back up. So we've identified our trend bias, right? We got a good time frame. We know the trend is going in our favor. We've got a small risk. We've identified exactly where we want to enter. We've identified where exactly we'd stop out if we did enter. And that risk range, difference between entry and stop loss. Okay, so we identify that number. Okay. And then we want to double that. Double risk range. That. And that's your profit range. Add to entry. Does that make sense?
Yeah.
We're just finding out where we're going to take profit. Okay. And then when it hits one of those two levels, right? And this is always the hard part, is just not doing anything until one of those two levels get hit. That's kind of that jar that we were talking about. It's inside the jar. Don't open the jar. Just leave it where it is. There's only really one way that we can justify taking action within that, and that's if we get a higher validated low. So I'll walk through those patterns here in a minute. But we really just want to identify those two levels. Okay. Now we got a choice. We can either take profit 100% at that 1 to 2 range, or we can reduce our position and lock in some profits. I'm jealous of that back rack, by the way. I heard that.
Sorry.
No, it's good. I've been trying that for 10 years. All right. So we've got our profit range. We've got our risk range. We know we're going to get a profit or a loss, right? Now, do we want to apply the 1% rule? Probably, right? But how do we do that? Okay. Before we get into the profit range, what we need to do is figure out our position size. How many times can that risk risk range go into our 1% loss? Does that make sense?
Yeah.
Okay, so 1% of portfolio, which is $30 for your we're using the speculation amount, right? We're not using 30% of the whole, or 1% of the whole portfolio. We're just using the speculation amount. So how many times can that risk range go into $30 for now, right? Once we hit $900 or $1,100, that'll change. But for right now, it's $30. Nice clean risk number. We can always identify it. It's beautiful. I'm sorry, this is $3. How many times can that risk range go into $3? My bad.
I can't do math, so.
Okay. Well, this is where we can make a spreadsheet. You can pull out a calculator. Ultimately, what you're going to do is you're going to find that risk range. Let's say it's 24 cents. Okay. And you're going to say, okay, well, how many times does 24 cents go into $3? It's about 12, right? 3 divided by 24 is 12.5. So you'd buy 12 shares in that case. And then, so this step right here basically tells you how many shares you would need to buy in order to potentially risk that $3.
Okay, so according to what we have written right now, pretty much each trade is going to be no more than $3.
Each loss will be no more than $3.
Loss.
Yep.
Got it.
Because what you got to do is you got to take that number that you get from this step, and you got to multiply it by the share price.
Okay.
Yep. So if we come back here, sorry, I got to switch windows here. If we come back to TradingView, right, and we say, okay, I'm watching NOMD tomorrow, right, and let's say I want to do $100 max risk, right, because I'm on a $10,000 portfolio here, so my 1% would be $100. Okay. What I could do is I could take that $100 and divide it by the risk range. So let me just plot out the risk range here. All right, and I'm going to do this with a drawing tool just so it's a little bit more accurate. All right, and what I'm looking at specifically is the open, so the O here, and I'm looking at the L. Are you able to see those? All right.
Yeah.
So the O here is 1870. Okay, so I need to go in here, and I need to look at the entry price, and I can say, okay, 1871, right? Because I'm not going to get filled till 1 cent above that. Right? And then I need to look at the low and say, okay, it's 1848, so I can change that to 1847. Right? So 1847, because 1 cent below that is where I actually get filled. Right? Easy peasy. And then I sell for X here. I can just move this number here, this take profit. I can just move it up. Till it's 2. Yeah.
Okay.
You see this number right here? This risk reward ratio?
Oh, okay. Yeah.
You just change that up and down until it turns to 2. Or whatever your multiple is. Right? So in this case, it's going to be 1919. That's my target. So I'd use that number later when I go to set my actual order up. But the one I'm interested in right now is this right here where it says stop. I kind of wish I could make this bigger. It says stop 0.24. So this is actually a 24-cent risk range, which is insane. I literally didn't do this before. It just happens to be 24 cents. But what I'm going to do with that number, since that's my risk range, is I'm going to take my $100 max loss that the 1% of my portfolio, and I'm going to divide that by 24 cents. And say, okay, it's going to ask me to buy 416 shares of this stock in order to... Oh, go ahead.
Sorry, I was going to say, since mine would be $3, I would divide 3 by 0.24.
Exactly.
Or,
yep.
Yeah,
that's it.
That way.
That's it. How many slices of this pizza of the same size slice will add up to this number that I need to make sure I don't exceed when I take my loss? All right. So for you...
It's like I'm doing that really quick.
Yeah. So you'd have to buy 12 shares. Yep. So you always round down, right? Because you don't want to over-allocate. Yeah. Right? So you'd buy 12 shares. Sense. Now what you'd need to do is you need to take that 12 and you multiply it by the share price or your entry price of 1871. So in your case, it would require $224.52 for that one trade. Okay? So if you're risking 1% of your portfolio, you might have to put in 22.45% of it in order to limit that loss to 1%.
Yeah.
Okay? Now, the good part is you get a $6 profit if you're right, because you're going to lock it at 2%. So 2% of your speculation amount is your end result. Okay?
That makes sense, yeah.
All right, so what we're really after here is to see whether or not that number exceeds the amount of money that you're willing to risk at any given time. Does that make sense?
I think so.
Okay, so let's bring it right back here. So once you find the number of shares, we see if it fits our budget. So in your case, if you're using $300 for speculation and it's going to cost you $224 for this trade, that is something you could take, right? So that's kind of a pass-fail, because if you brought that same number down to, like, let's say 10 cents, okay? If you're risking $3 for a 10-cent risk, that means you got to buy 30 shares. At $18.71 a share, that's $561. So you couldn't take that and still have your risk limited to 1%.
Okay, but I don't want... I can't do 200... Wait, I'm lost a little bit.
No, you're good. So in this case, right, what we're doing right here is we're identifying a threshold where you'd apply the 1% rule. Because no one should ever turn down a 10-cent risk, in my opinion. That's a beautiful risk, right? So what do we do then? We just use a flat position. So you can just throw $30 in, buy 2 shares. So your risk is always going to be smaller than 1% at all times. It's just a matter of whether or not you're applying the 1% rule. Does that make sense? Yeah.
Yeah.
So in this case, it's 24 cents, which means you'd kind of have to, right?
Yeah.
And it's it's going to just depend on you. I mean, I would personally always try the 1% rule first to see if it fits within that $300 range, because that's what's going to get you those consistent 2% profits, 1% loss results. But if it goes below that, the worst case scenario is you just use a smaller flat position of like 30 to $50 and you're good. Because that's, it's insignificant at that point, right? What you don't want to do is just use flat positions though, because you might win 12% on one trade and your other one might be a 15% loss, right? So if you do that, you're going to have a disproportionate win-loss ratio overall, even though the trades themselves still had that 1 to 2 risk reward, right? So it's just a little bit of a fallacy that we have to address up front. So that's it. So once you figure out the risk range and how many shares you need to buy in order to limit your loss to 1%, you just check and see, does it fit my budget? Does it fit within the amount of dollars that I have for these 10 trades at any given time? And if you're just doing one trade at a time for 10 trades, you'll probably be fine, right? Then we can set our risk range. Our profit range. So you double the risk range and add it to your entry, and that's where you take profit. And then we got to make a decision, right? Do we want to lock all the shares at that 1 to 2 risk reward? Or do we want to have a partial? Do we want to scale out so that we can optimize those profits at the expense of potentially, coming down and hitting the stop loss after we lock in the bulk of it? Personally, I like 75% at the first target. That does cap your profits on some level if something does sell off after you take that profit. But at that point, you're still net profitable, right? So it's up to you.
75 is what I have used before.
Okay.
So yeah.
Okay, cool. And just for anyone who's watching this, because it's going to be a mentorship episode, the reason we want to do that is if you lock 75% of your shares at a profit, then your remaining 25% of your shares has to go not only down to your break even, but 3 times that profit distance before you give those profits back. It's just how the math works. It's pretty awesome.
Which would your stop loss would hit first.
Absolutely. It's in the way it protects us. So if we had $100 and we locked 100 shares, we locked 75% of that at 10%. That would be $7.50 in profit, which means the remaining $2.50 would have to lose 3 times basically on that one trade, which means it's got to go super far down before we lose that profit. So that's the only reason we do that. Of course,
which is what happened to me on a trade.
Yeah, we've all been there. Of course, the downside there is if your loss hits, right? If you hit your stop loss, you lose on 100% of the shares. So if you do that constantly, yes, you're going to have some problems getting net profitable. But fortunately, the way we're stacking this, we don't need to win all the time or even half the time. Just be like BebNet, quarter of the time, boom, you're profitable. Or at least break even, right? And if that happens, that means there's something else going wrong. All right, so we figured that out. So so let's say the money's in the jar, right? It's sitting there, boom, we hit our take profit. Okay, so we lock 75% of our profit at TP1, right? That's take profit number 1. And then we don't do anything else, right? We don't have to move our stop loss up. You can move it up to break even if you want to, just so you don't lose out on the rest of those shares. Not a bad idea. I personally don't, but you can. So we'll do that, right? Consider moving stop loss up to entry. Not required, not even preferred in my personal book, but and then we're going to look for 2 things. Right? We're either going to have a 5 candle run, 5 candle run, and I'll walk through these specific ones here in a second. Or we're going to have a HVL or higher validated low, right? Which again, I'll walk you through these. 5CR, I often refer to these as. I can't type today. All right, and then in this case, we're going to lock 75% profit. And I'm just going to copy that because I'm lazy. We're going to move our stop loss up. Okay, does that make sense? So we're going to look for 2 patterns with whatever number of shares we have remaining until we run out of shares. We're just going to repeat this process over and over and over. loop until no shares remain. Okay? So this is just our take profits cycle, and it's pretty cool once you break it down. Let me look. Let's go back to the chart here. Well, first, does that make sense, right? So we entered. We know where the risk range is. We know where our initial take profit is. We're going to lock some portion of it, the bulk. Then we're going to look for 2 potential patterns and take action based on whether or not we see those, right?
Yeah.
Okay. Let me jump back over here and I'll share my screen on TradingView so we can actually look at some examples here. All right, you can see my screen?
Yep.
All right. Let me just, what specific ticker that was? I think it was an LTH. CDMO, I think it was. DMO, I think it was on the 1 hour chart. There we go. I already got it mapped out, so I'm just going to show you this because it's already got the examples kind of in place. See all my garbage?
Beautiful.
All right. So in this case, right, this was Bebnet was watching this. We were talking about it a couple of weeks ago, and we just happened to look at it again. But this is the one that he mapped out. So let me turn extend hours off. We don't like those. All right. Stupid interface. I'm also going to collapse this down so we can see it full screen. Are you able to see that okay?
Yep.
Okay. So here we've got a positive slope on the moving average, right? We've got 1, 2, 3 candles that are red. Whoops. So for each of these, as they formed, right, we would have seen this. Now that's a little bit high off the moving average. Maybe we don't want to take that size risk. Then we get this guy. And this is perfect. This is a nice tiny risk. So we move our level down to the open price. That's the threshold. Right? If price goes up, we look for an entry. If it goes down, we look for another candle. Right? Until that level's broken, we just follow it down into the moving average until it breaks. Okay? Then we get another one. So we can move this price down here because the open is still above the moving average, so it still qualifies. Okay? And then we get a price break. Okay, so this is when he took entry, so he's watching it. Let's say we're following along here. We know our entry, we know our stop loss, we know our risk range, right? So we've got all the criteria that we need so far. We've identified our position size ahead of time because we knew when that candle was going to cross. We knew what the potential risk range was. All that good stuff was done ahead of time. Okay? So we take the entry, we set our target. I'm going to move this back down to where it was. It's a 1 to 2 take profit. I think it's like right here. Okay. So that was the initial take profit. So 75% of the shares locked in at this point. You got 25% left. Okay. The price kept going, and then we get this. This is a 5 candle run. It's just 5 candles in a row that have higher lows.
Oh yeah.
As soon as the 5th candle closes, all we got to do is put a partial stop loss in place. And then for every subsequent candle that forms with a higher low, so you can have 12 or 20 of these in a row, we just move our stop loss up. Every time one closes, that claims where the stop loss goes. So we don't want to keep it on the current candle, the one that's still moving up and down. We want to put it just on the one that's closed. Does that make sense?
Yeah.
All right. So in this case, we got a little wick dip. So we would have locked 75% of the original shares that were left, which would be 25 of what was left. So we're running out of shares pretty quickly here. Unless we have a massive account, it's not going to be a whole bunch of profit, but it is a much bigger range, so it balances out. So the profits you get on these big runs could still be on par with the amount that you lock in down here if you do it right. Right? So once this low forms, right, we're automatically looking for a higher validated low at that point because we know that we're forming lows on the candles. So no more 5 candle. So we're in low hunting mode, bottom hunting, right? So in this case, we don't get it, right? Because this one can't be a good candidate because it needs 2 candles to the left and 2 candles to the right with higher lows. So this guy's right here, but this guy's down here. So this can't be a higher validated low. So it's still part of this overall impulse, right?
Yeah.
So then we get this guy, right? As soon as this candle here closes, this validates this guy as the higher validated low because that's 2 candles to the left, 2 candles to the right. They don't challenge the low here, so this becomes the higher validated low. And as soon as this candle here closes, we move our stop loss up to right here. Does that make sense?
Yeah. And at this point, that would be 2 hours, right?
Each candle here represents an hour.
An hour.
Yep. So it'd be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 hours in. So this is a overnight trade.
Yeah.
Right? So now also, because we have these 3 candles here, each of these has a higher low. Once we've got a higher validated low, we start looking for those 5 candle runs. So we're back in 5 candle run hunting territory, right? Because we want to catch these impulses. It's 4, 5, right? So as soon as that candle closes, we lock in that 5 candle partial stop. Okay, so at this point, we've got a very small amount of shares left. And then it gets broken right there. So we lock in another 75% of what's left. So we've got a very, very small amount of shares at this point. Okay, and if this validated low gets broken, that's the full stop. So your main stop loss here for 100% of shares, that gets moved up to here. As soon as the price breaks below that, wherever it is, you stop out completely. There's no reason to justify being in that trade because they came down, they tested it, and its neighboring candles couldn't breach below that price. Therefore, the justification should be to the upside, right?
Yeah.
All right, so 1, 2, 3, 4, 5 candles in a row. We get a low, so now we're automatically hunting higher validated lows at this point because we're now making lows, right? So 1, 2, 3, and then we get this guy as a candidate, right? He's the only one so far that has 2 on the left that are higher. So let's see. I know the arrows kind of gave it away here, but so this candle closing validates this guy. So this is now the higher validated low. So we move our stop loss up, our full stop, as soon as this guy closes, right? Because you're not going to see that in real time until this guy closes. And then automatically we get a 5 candle run, 1, 2, 3, 4, 5, right? So we're always just flip flopping between those two until something breaks, right?
Which it looks like it did.
Yep. As soon as that broke,
Judging by the arrow.
Yep. So it broke the 5 candle rule here. So we lock in 75%. And since we had our main stop loss here, it broke on this wick. So we're all out at that point. There's no reason to be in that trade, and we don't even need to look back at it, right? It kept going. We don't care, right? Because there's another opportunity right here. So why the hell would we care, right?
Yeah.
There's this one. This did break to the upside, and it broke to the downside, so this would have been a loss. So we can always just, document that too, right? There's always opportunities here. And then, we don't know which one of these happened first. We don't know if the entry got hit first and then the price broke down here. We know the candle opened down here and it closed here and it went as high as this. That's all we know. We don't know anything else, right? So if you wanted to, you could map this out and you could say, oh, in real time, this would have been the low, it broke, blah, blah, blah. But then we get another entry right here. And then that would force us to push this out, right? Does that really matter at the end of the day if we're using the 1% rule and our losses are the same size? It doesn't.
Probably
right?
not.
Probably not. We can still take this trade. It just means it has to go a little bit higher for us to take a profit. But our loss and our profit will be the exact same as over here, assuming we're not scaling out and stuff, right? So we can choose to pass on that. We can just filter these down into super small risks like this guy right here. Right, we got our positive slope, so anywhere in this range we can do stuff, right? We just need that positive slope first. All right, so if we're looking at this guy, let's let's just walk through it in real time. Not real time, but playback. Right, so we got this candle. Okay, so if I'm watching this from hour to hour, right, I got these 2 levels I can work with. It's a positive slope, we got a tiny red risk. I don't know what's gonna happen, right? All I know is I'm gonna potentially take a risk on it. Okay, so maybe we got an entry, maybe we stopped out. At the end of the day, you're not in this trade anymore because you did stop out at some point. And it didn't go high enough to hit the target, so there's really no wiggle room here. That was a loss, right? Doesn't matter. They're insignificant, they're small. We're going to get a bunch of those, right? But we're also going to get big wins like this, so it doesn't matter. All right, what we also have here now is a red candle and a threshold, right? Now this one's a little bigger, so maybe we could pass on this one, right? It's not as tiny as this candle.
Yeah.
Doesn't really matter because we got the 1% rule, but it's just personal taste. Right? In this case, it would have worked in our favor to let that one pass. But still, it's still just 1 more percent that we could have, potentially lost, right? It's always the same size if you do the 1% rule. It's awesome. But we also have, so far, we've got a positive slope or relatively flat slope. We've got an entry threshold and a risk that's kind of bigger, right? It's 19-cent risk. And in this case, that one would have stopped out. So in this case, we've got this down here, but the opening price, the most recent red opening price is up here, right? This is below the average. We can't really trade that. Okay, but we do have an expanded risk range. So again, 1% rule is our best friend. It doesn't matter, right?
Yeah.
So in this case, you would have stopped out just a little bit. Or I'm sorry, no, this one hit first and then it pushed up. My bad. So that would have been your stop loss, your new stop loss range, right? Because it pushes down and then pushes up. So you would have taken an entry right here. So that tells me, if I want, I haven't looked at the rest of this chart, so I don't really know what it looks like. So we're just going through it in real time. Let me just compress this down here. Right. Let's just push this over. Yeah. Right. These are my levels. Okay. Roughly. I mean, you're gonna go 1 cent down, 1 cent up there, blah blah blah, all that good stuff. Let's just walk through it, see what happens. So in that case, you would have had a nice little crazy profit in there. It's not really that big, right? It's 3% here and 2%, 3% there. So 4.79% profit in exchange for maybe 1% losses. You've got 2% win so far, right? Not super profitable still. Overall, you'd still be down like net 1%, right? But then we can get into scaling out, right? So we've got 5 candle run, exactly. So let's draw it out. And our main stop loss is still down here. So what I can do is I can make that a red one, right? Just so we have that. All right, there's 5 candle rule. Let's see where it goes. It's turned into a 7 candle rule. All right, so this one right here, right? As soon as this candle closed and this one opened, that's where you would have locked your profits, or you would have moved the level up, and then you would have taken your profits as soon as that broke to the downside. Does that make sense?
Yeah.
Okay, so you've locked 75% here, 75% here. Okay, so you're still not making a huge profit, right? But you're now in low hunting mode. So let's go ahead and see if we get a higher validated low. So I'm just going to push through these because I know I need at least 5 candles. All right, so right here would have been your stop loss. Boop-a-boop-a-boop. Right? You would have stopped out. That's it. Well above your target. Or above your entry, I'm sorry. Just above your target. Right? So then if you take this and you apply not only the 1% rule, you're getting more than 2% profit here. Right? So you just do that a couple times and you're fine. You get a trade like this where it just goes and goes and goes, and you're going to have a bunch of those. As long as you can scale out appropriately, you're going to be fine.
So on that second green candle after your entry, you would have hit your target and taken 75 out already.
You mean this one here?
Yeah.
Yeah, right here. Right as soon as it hits that target?
And then you would have taken 75 again at the white line.
Up here, yep.
Yep. Okay.
Perfect. Yeah, you're picking up on it so fast. That's good stuff, man. And like right here, for example, if I look at this on the daily time frame, okay? Let me get out of this replay mode here. Right, I'll show you exactly what I'm going to do tomorrow. Right, I know my levels. I know I've got a level at 1871, and I know I've got a stop loss here at 1847. So what I'm going to do is I'm going to open my little paper trading widget. I'm going to hit trade, and I'm going to buy a stop order.
Okay.
Right, because what that's going to do is it's going to say when the price goes up above this level, it's going to buy them. So just
that makes sense.
It's just a more complicated order type. Like most people just buy and sell, but this is like a short seller stop loss basically. So anyone who wants the stock to go down, their stop loss is going to be right here with this kind of order. We're just going to use that as a long trader to catch the entry. Right? So what I can do is I can enable take profit stop loss already. So when I place the order, those brackets will be there, and then I don't really have to do anything. I just got to monitor it, right? So in this case, my entry is going to be 1871, right? Because that's above 1870 by 1 cent. And then I'm going to do why? Why? That's weird. All right. Well, anyway, on a real account, that's what I would do. That's weird. I don't know why that's doing that. Either way, anyway, you place a buy stop order in a normal broker. And what you can do is when you can attach a stop loss take profit to that order, and then when the order is filled, it'll automatically place the take profit and stop loss, and then you can adjust those.
Yeah. So what I've been running into with Webull, for example, is I've been doing that. I've been doing, I think 10%, 20%, something like that.
Yeah.
For my take profit and stop loss. However, it sets itself automatically to 100% of the shares.
Oh, that's weird. Is that the?
Yeah. I think I need to, because I've been using Webull's trade.
Oh, okay. They have default quantities. Yeah. Is that what you're using?
I don't know. I gotta look into it, I guess.
Okay. Well, let me share that real quick. I got everything. I'm a one-stop shop here. Can you see this?
I have mine open too. Yeah.
Okay. So I'll just turn off extended hours because I hate that.
Let me adjust my window cover.
Sure.
Much better.
All right. So I've got my order widget down here, and if I'm looking at, what's that ticker again? That was NOMD. Right, and I'm actually going to take this on my $1,000 account, just so you can kind of watch tomorrow if you want. I'm going to kick it up to the daily time frame, and I'm going to plot out the same level. So I'm just going to do 1871. And what was the other one there? Well, it should be the same, right? Wait, why does that look different? Oh no, dumb. Because I'm an idiot. That's why I was looking at the wrong candle. So this is going to be 1 cent below that, 1847. Right. So that's my stop loss. Got my entry, my stop loss, and then my target is going to be up here at 1919. Right. So I'm just going to draw a line there, 1919. Okay. So I've got the values here. When I go to put the order in, I know exactly where they're going to be.
Mm-hmm.
So I'm going to place a new order. I'm going to do buy, and then I'm going to do a stop. Right? Okay. And then I'm going to figure out how many shares I need. So in this case, I'm just going to use the full 1,000. So 10%, or I'm sorry, 1% of that is $10. Right? So my max risk is going to be $10. So if I pull up my calculator here, $10 divided by whatever this risk range is. So let's figure that out first, right? 1871 minus 1847, 24 cents. We already did that, right? $10 divided by 24 cents is 41 shares. Now, can I afford that? 41 times 1871, $767.11. I can afford that. Okay? So I'm going to do 767. And then I'm going to do, whoops.
I don't think that's right. That's shares. Is that shares or is that?
No, you're right. 41 shares. Okay, my bad.
I was like, I don't think you can afford that one.
No, that's like, all right. So, okay. So that's it, right? I got the ticker. I'm just buying shares. I'm using a buy stop order so that when it goes above the price, I get filled. My threshold is going to be 1871. I'm going to buy 41 shares, and my max risk there is only ever going to be 1% of my portfolio, which is $10. As soon as I place my brackets. Now, if this is probably not what we want to use. I personally like the other trade widget, this one.
Yeah, that's what I usually use.
Yep. So you can see down here I've got $1,000 and $1,006. My bad. I might have done some trading. So I'm just going to put those same numbers in here. So 1871. It's going to be a buy stop order, and I'm going to buy 41 shares. Right. That's 1871. And you can kind of see it pops up as I put the order in.
Yeah.
Well, except for that for some reason. I don't like this. All right. Then I can hit stop loss, take profit, and I can put these into dollar amounts. Or sorry, not that. Price. Sorry. Okay, so I can put these in at my levels that I punched. Right, 1919 for take profit. And obviously GTC is good till canceled. I want to keep that because I don't want this to be an order that expires at the end of the day. So what I can do here is I can just double check it, make sure it's all good. I'm buying a stop order, 41 shares, 1871 is the threshold. I got my stop loss take profit set, so I'm going to place this order right now. And you can see it's got the brackets already set.
Yeah.
Okay. So, but I don't want to do this. Right, because that doesn't let me scale out. So how can I get around that? I can cancel this. And I can multiply 41 times 0.75. And it's $30.75 or 30.75 shares. So, oh, that's weird. Sorry, it popped up with a sound. So instead of buying 41 shares for this, I can do 30 shares. Right, I can do 2 separate orders of 30 and 11, and then I can move those take profit and stop loss independently without having to stop at all my shares or sell all my shares for a profit. Does that make sense?
Yeah.
Same numbers, same exact numbers. I'm just changing the quantity here. Okay, so what I can do is...
and then you have 2 orders with 2 different take profits.
Same exact stop loss, different take profits, yep. So I'm going to place that order. Okay, and you're going to hear a bunch of bells go off, I'm sure. And then what I can do in Webull, which is pretty cool, is I can just do 11. I just change the quantity. And then I can come over here. and I can grab this 11, just drag it up. That's it. So now, if the price breaches below here after it's filled, so none of this happens until the price goes up and it breaks over this level. And if it doesn't, I can, you know, like if it just goes down here and sells off and all that, I could just cancel those orders. No harm, no foul. Right? But if it goes up and it triggers this entry, my stop losses for all 41 shares, even though it's 2 separate orders, it's still the same number of shares, is right here. So no matter what, right?
Okay.
I'm not moving this up or down. It's staying put. But my take profits, I have 2 separate ranges now. So if I want to lock 75% of my shares here at this 1 to 2 take profit, I got that. That's in place. And now I've got another sell order up here for the remaining shares. I don't remember what number that was, but oh well. Where I can have this hanging out up here and just move it down when it's time, right?
Yeah.
And that's all I'm going to do. So I'm just going to leave this up here at 10.5% just for fun, right? Just see what hits.
Who knows?
Yeah, because when this goes off, this will tell me, right? It'll say, hey, an order's been filled, pay attention. And then, you know, if I see a higher validated low, all that good stuff, I can just move both these orders up and just repeat the process as needed, right? So this is set it and forget it territory, right? I don't have to work too hard for this. It's just doing the math a couple times and getting the process down. But once you do that, second nature.
And that's what's nice about the daytime frames. It's
nice
a lot
and slow.
slower.
Oh yeah.
If it was on a minute, by the time I got my second order placed, something would have happened. And
you got to have that process down long before that. Yep. So, well, I want to walk through this on the. I'm going to grab the watch list. So, I'll do one of these really quick. I do have to jump off of here pretty soon.
Yeah, no worries.
But I'm going to go ahead and grab the watch list from. Well, I'll leave this up here, right? Because we're not. You don't need to see all that. I'm just going to grab Lee's watch list from the morning.
You'll have to let me know how this play goes if you're going to hold on to it after this.
Oh, it's in my account. Yeah, I will.
Yeah.
I'll do 10 of these right alongside you. But mine will just be on a real account. You do yours on paper. Easy peasy.
Yeah,
so eLab, right? So for these, I typically like to use like the 15 and the 2, right? So in this case, this was the start of the day, right here. Okay, we had a positive slope until we got to here. All right, so this is the red for the day. Okay, so now we look down at the 2-minute. Is the 2-minute clean? I'm gonna make sure. See this. So the 2-minute's pretty choppy, right? Like we don't really like this. There's a bunch of wicks, and it's hard to identify. There's stuff we could take, but nah, right? So we look at the 3-minute.
I think we're on the wrong screen.
Oh, my bad. I'm sorry. You're right.
I was saying, hold on.
I know I meant to switch something over. All right, can you see that?
There we go. I can see that.
Okay, so here's the 15
Now
minute.
where your mouse is moving makes more sense.
Okay, perfect. So here's the 15-minute chart, right? And we see that we've got a positive slope. The yellow line here is the beginning of the day. The red line is when the slope turned negative. Right, so we had a positive slope coming in, so this is green light go territory. We can just trade the upside until this slope kind of goes down. So I was saying we want to look at like the 2-minute maybe. The price action's kind of garbage though, right? Like you got too many wicks here. You got some gaps between candles. Like right here, it's just a little bit messy. It's unreliable. It's not clean, so I can't identify my risk. Right? So we kick it up to 3-minute, see if that's any better. It's a little better. Right? And I'm only focused on this area here, right? For trades. So I don't really like the 3-minute because you got all these, like this is garbage, right? You don't want gaps and wicks like that. So 5-minute maybe. Right? Like as price is forming, you're going to see this, and then a massive sell-off, right? So this is kind of where you'd start to look for those color changes. You got a nice tiny risk right here. Maybe that was a stop out. But this is, it's below the moving average, so we don't really need to take that. And again, I'm only looking on the local time frame too. This has to have a positive slope. So like this right here might have been a good opportunity. So like from there to there, and then a 1 to 2 take profit. I don't know if that actually would have hit or not. Maybe, maybe not. Who knows? But then we turn red. So maybe this one just wasn't the best one for the day. Right? It's not clean. We had one opportunity that I can see. Not the best. Not the best one. So let's look at RR. Okay, and again, I'm just going to start on the 15 minutes, just a process. You just do it over and over and over. Here's the start of the day. Oop, make that yellow, not red. Okay, and then we had a positive slope all the way up to here. Right? Plain as day. So in the morning, this is what you would have seen. Market opens, blah, 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 blah. You wouldn't have known it turned red back there. All we know is it's green coming in. That's all we care about. Coming down to the 2-minute. Right? And this is our trade range for the day, right here. Just this block of stuff, right? So let's take a look. Is it clean? I don't like this. This isn't clean. I don't like it. So let's go up to the 3 minute. It's a little better, but I still don't like it. Oh, sorry. I got to look back here where the actual entry opportunities were. Oh, no, it's over here. Sorry. I was at the right one. Right? That's too many wicks. I don't like it. It's probably a low float stock. So let's kick it up to the 5 minute. All right, this is a little cleaner, right? We got some good stuff here. It's a little bit messy, but you know, maybe not. All right, so let's take a look. So slope turns green right here. So let's start looking for tiny red opportunities. We got an opportunity up here, but it's a little high up and it's kind of a sizable risk. Same here. And then we get this guy. All right, that's nice and tight. It's close to the moving average. We got our risk, and then our take profit would be somewhere up here, right? So in that case, that would have worked if we use the 1% rule. Easy trade. But maybe we don't use the 1% rule. Maybe we just don't like that risk range, right? The cool part about this is it doesn't matter. There's going to be a million opportunities. There's another one, right? Nice and tight based off this candle. It breaks here. So as this is forming, this would have become the risk range, right? Because this one didn't break over, right? So that's the risk range there, and then massive potential to the upside, right? So let's walk through it, because we're not going to get that all the time. So 1, 2, 3, 4. We don't have a 5 candle run. Oh, sorry, the target would have been somewhere around here, maybe. I don't know. We don't have a good candidate for a higher validated low. We do have 1, 2, 3, 4, 5, and then we get a 5 candle run right here, followed by a higher validated low right here. 1, 2, 3, 4. What's the low on that? They're equal, so that's okay. 5, 6, 7, and then it breaks, so another 5 candle run at the same exact level, right? Let me just erase all these. So this would be our stop loss at this point, above our entry. 5 candle run, boom, we get a higher validated low right here, as soon as this guy forms. 1, 2, 3, 4, 5, what are these equal? Yeah, they're equal. 6, 7, 8, 9, 10, 11, right? 11 candle runs. So there's some more profit right there. Higher validated low right there. Right? So all you need is one that catches, right? 1, 2, 3, 4, 5, 6, and then we break right there. And then we get a higher validated low right here. And then it finally breaks down and we lose the rest of our shares around 230. Right? So we entered down here somewhere, right? Whether it was here or here, it doesn't really matter. Right? We got two.
I feel like that at that point I wouldn't even be upset when it hits. I'd be like, that was great.
Exactly. And then you check back later in the day and you see that it jumped up.
Yeah.
And
then you get some.
Yeah. But who cares? Like that's oh, sorry, I grabbed the wrong day. This was yesterday. My bad. But the process is the same. It's all the same stuff, right? So maybe that wasn't a huge profit, right? But it's better than a huge sell-off, and we don't ever have to trade sell-off if we don't want to. Next one up would be NCNC. Right, I'm just going to kick up to the 15-minute here. That's garbage. There's nothing there. Like it's just flat price action. And that's always important to just look at the higher time frames, especially with these low float runners, because when this opened, if we look at the 1 minute chart on this, right here, this thing gapped up crazy, and I'm sure the pre-market action was great, but then as soon as the market opened, it just fell right down. No reason to trade that on the 1 minute. It's garbage, right? So I always like to start on the 15-minute with these. SPRC, we love this one. It's an old one. Nice classic ticker that we love. But that doesn't mean it loves us, right? So the beginning of the day is right here. That's our yellow. Right, that's where the day starts. And then we kind of turn red right here. Okay, so let's just look at that small window. Did we get an opportunity or did we get crapped on? Look at the 2 minute. That's kind of garbage, right? There's really nothing we can trade there. Maybe this guy, right? Maybe. But we got all these gaps and stuff. I wouldn't have been looking at the 2 minute. 3 minute, that's garbage. 5 minute, garbage, right? You see all these gaps look like Morse code?
Yeah. You don't want to trade if you see those.
No.
Essentially.
Yep. So maybe we pass on those, right? There's no like need to have to trade these. You know, we get a positive slope here. You know, it's always important just to map these out on the higher time frames because you're going to see, sometimes you're going to see this flip-flop stuff, especially in these biotechs and stuff, the runners of the day. And then there's that. And just kind of mapping them out as the day goes by. You know, popping down here and looking on like the 5 minute. Maybe you decided to grab that. Maybe you decided this was too dumb. Like there's nothing here we can trade, right? Yeah, there's really nothing on this chart that I like other than this thing. And that was kind of the only real clean opportunity aside from this guy up here with super tiny risk, right? All the rest of this is garbage. So not only did you not make a huge profit, maybe you took some small losses for the day. Like that would have been a winning trade and that would have overruled this one. All right, so you took 2 trades, you lost one, you won one. You'd still be net profitable. But most importantly, you missed out on all this garbage that everyone else is stressed out trying to figure out if they get it right. Right? That's you only get so much time and money on this planet. Like, don't blow it on guesses, you know?
Yeah.
All right, so I do have to jump off here, but what I want to do for you specifically is I want to have, well, I'd like you to practice first, right? So I want you to go out, look at some charts, pick any just random 10 tickers, look at the daily time frame, and backtest. Okay? You can put those in our chat. You just want to shoot me DMs, say this is number 1, this is number 2, and what I mean by that is just grab a random ticker, go back historically, just pick a random day, okay, where the slope is positive. That's all I care about, right? Find the nearest risk from the MA, from whatever random date you picked, plot the entry, plot the risk, figure out how many shares you would have need to have bought, whether or not it would have fit your budget, plot the target with a 1-to-2 ratio, and then see what the end result is, and then just log that information somewhere, ideally with a screenshot if you can. So I'm giving you some homework here. Do that 10 times. Post them right in our DM, and I won't answer, like I won't critique them or anything until you're done with all 10, and then we're gonna look back at that data together in the next Monday.
Got it.
That sound good?
I think so. So pretty much all we wrote out right here, just log.
Yep.
Keep track of everything. Sounds good to me.
All right, what I'm going to do is I'm going to edit our pinned message in our DM, and I'm going to send that, so you'll always have a copy of it as well.
Perfect. And I got it all written out too.
Oh, perfect. All right, so what I want you to do is just send those 10. It doesn't have to be today. It doesn't have to be anytime super soon, but if you have them by next Monday, that'd be great because we could talk about them. But that's your homework.
I'll work on it throughout the week.
All right. No.
I think I might actually do that one trade we were just looking at earlier. I might do that same one.
Oh, NOMD?
Just to, yeah.
Okay. You gonna try that one in real time?
I'm gonna do it on paper, but yeah, I'm gonna try doing the real time. Just kind of.
Perfect. Okay. When you start doing real time trades, I want you to add something else to this that list of homework items.
Okay.
I want you to write down your external factors. So like how is your environment, can you focus, right? That's what I'm looking for.
Yeah.
Can you focus? Is your clothing too tight? Are you uncomfortable? Did you not sleep well? Are you sick? Are you fighting with the girlfriend or whatever? Is your boss breathing down your neck? Like, do you have distractions, right? That's ultimately what we're here for. Because when we're distracted, we're stressed. When we're stressed, we do impulsive things. Okay, so the more you can document, the more you can document cleanly, the better data you'll collect, and then the better you'll be able to identify trends that you might just not notice from trade to trade or from day to day. Like you might say, oh man, I actually fight with my boss quite a bit. And when I do, it really takes an impact on my trading. I realize that I deviate from my plan a lot, little things like that.
And today I was, so I'm just not gonna trade today.
There you go. Perfect. And then, maybe you get in a fight with a kid or something, you're like, oh, I'm going to take it out on the market. Nobody says that, but that's what our brains end up doing a lot of times. We just want some dopamine, so we come into the market and say, oh, I could win big today. What if,
Yeah.
Our impulse control is it's through the floor at that point, so we're going to do silly things, right? All right, cool. So I appreciate that. So I'm going to end the recording. So thank you all for watching, and we'll catch up next Monday.